Good morning, ladies and gentlemen. Well, it looks like from the headlines that we will have a debt ceiling deal. And from the little I've been able to get so far from CNN and just news outlets, because we don't have the precise details as yet, it looks like it's a pure spending freeze with minimal cuts even in 2024, if there are any at all, which basically means that the fiscal drag that we're going to have from this deal is minimal, if any, and therefore everything is back on Jay Powell's shoulders, and that any inflation has to be controlled through monetary means as opposed to fiscal, because fiscal policy is going to remain expansionary as opposed to what we were hoping for, which basically means that the pressure will be on bonds as opposed to equities. So now let's have a look at the implications. I think it's going to be helpful to remind ourselves where the yield curve was end of February, basically just before the banking crisis, let's so call it. And I think that we are basically going back there. As you can see, 20s and 30s unchanged. What is that? 3 basis points. But have a look at the twos. The twos are 45, 46 basis points below where they were. And really, the story now is going to be one of going back to that shaped yield curve. There's still going to be a kink, 3s, 5s, 10s, I believe. So very much similar to the orange line. It has to be, because now there is no help that I can see from what's been reported from the fiscal side. And if there's no help from the fiscal side, everything goes back on the monetary side. The odds after the PCE data that we had on Friday are now, I would have thought, 70-30. That article that Waller came up with, i.e., do they stop, do they skip, or do they raise? I would have thought if this debt deal is confirmed, there's not much else they can do but continue to raise rates. And I would have thought now something like 5.25 to 5.5 terminal has to be favored, in which case the yield curve is going to flatten quite a bit. And let's not forget, this is all coming at a time when inflation expectations are not exactly coming down. This is what we had in the past few days. As you can see, 233 on 5s is really basically as high as it's been, or very close to the highs since the end of 2022, October 2022. These inflation expectations are not coming down, and that is what was reflected in the PCE. And they're not coming down because wages are strong, and wages are strong because the employment situation is strong. None of the real data that you are seeing on the real economy, shows any kind of weakening that Jay Powell is hoping for to moderate how much monetary tightening he has to do. It keeps on going up. If we have a look at the break-evens, they are basically, the 10-year break-even inflation rate is still around 2.25. Whatever we look, if we look at the fitted instantaneous forward 2-year hence, it's going up. I would not be surprised at all to see it break these levels and go back to something like up here. Let's call it, 4. So the pressure has to be at the front end, because all we have done so far is taken out the cuts that we had priced in for 2023, and now we're going to have to start pricing out the cuts we priced in for 2024. No fiscal drag throughout 2024 means higher for longer. The longer, it has just been extended by months and months and months. So unless you can see real economic data start to come down, the tightening has to continue, or at the very least, the pricing of the easing has to be taken out and postponed. Therefore, I really can't see much hope for the very short end. With the proviso that all we know so far is that the deal seems to be no fiscal drag, and that can change. I mean, this deal could fail, it could not get passed and stuff like that. But from what we know now, with that very important proviso, I think twos are basically going to trade 475 to 499 again, without a doubt. What can you say? Powell has to raise rates again. The terminal rate I doubt is going to be reached in June, and I doubt it's going to be reached in July, because this postpones the moment of reckoning for the economy by another at least a year, right? No fiscal drag throughout 2024. We were hoping for fiscal drag, none forthcoming. Why would you own something at, if you think that it's going to be 5.25, 5.5 terminal, what good is owning 2-year notes at 4.55 going to do you? You're going to be having 1% of negative carry for the foreseeable future. Only when the economy starts showing signs of weakness would it make sense to own them at 4.55. Is that happening? No. I think twos are going to trade in this area again very, very soon. I just can't see any point in owning them. If we look at fives, they're going to be less impacted, because the way the forwards work, you're going to price out closer in rather than further out, and you could actually price more further out, because you're going to say, right, the rates are going to go up now, and that increases the probability of recession in 2024, mid-2024. And therefore you might price more cuts in, let's say, 2025 or late 2024, and less all the way before, which basically means that twos to fives keep on going out, and could go out quite dramatically. Okay, this is twos, fives, all they did. I mean, I've been bullish all the way here. I actually got out of a lot on Friday on that touch. But to me, any kind of a pullback, I don't think we've seen the highs in twos, fives. I think they could easily go to 80, 85, simply because of the way the maths works. To me, any kind of a pullback in twos, fives is a screaming buy. And, going back to the individual tenures, are 10s going to be hugely pleased with the deal? No. I think 390 to 399 is about as high as they go. And the 30s are the ones that are going to be least concerned, because they are already, as I showed you, trading where they were trading before the banking crisis. And therefore, I would not be surprised to see a spike of this level. But 419, I really can't see that being broken. And the reasons why I can't see it are important, because we know so much more about the speed and direction of inflation and inflation expectations. They are not at this level, okay? We know so much more than we knew back in October. We know that inflation is coming down. We know that tighter rates will have an effect on the economy. It's just a question of when. And therefore, I think it's the yield curve which takes the strain here, with basically the 30s being pretty well anchored where they are. Will they spike this and get everybody excited? Yes, but I think it comes back. 30s to me are the place where you can try longs. Twos, definitely not the place where you can try longs. And if we look at something like the twos 30s, I think that this gap is going to get filled, which basically tells you the whole story. The whole story is that the pressure should return to the front end. What about Germany? Well, we do have European CPI next week, and it probably remains higher than the US. But I think this is going to be a period in which the differentials actually start coming going further out, that the US is going to have higher rate reactions than Germany. The twos, at some stage, they will trade 341 again, but I think it's going to be at a slower pace than any movement in the US. Fives, I think this gap eventually over the course of the next 1 or 2 weeks gets filled. 275 to 285 is their destination. Tens, well, they're already there. Again, I think it's the same picture as I painted for the US. It's one of yield curve flattening. So if we have a look at twos, tens, I think that we will go back up towards these levels, around 55, another 10 basis points. But as you can see, this is a much slower rate of change than the one in the US. So unfortunately, I think I'm wrong. And when I have a look at the cross, it probably will go and trade these levels on twos, 178. But it's going to be another opportunity to reset these. Probably going to go to 155, fives, fives, and tens probably going to go to something like 137, 138, and then you're looking to return back down. So unfortunately, looks like this level, although was the wrong level to try anything, I would have thought 143, 144 is entirely possible, and that will be the level to try again. Because I do think that eventually those differentials come in towards, at least 105 again, and something like the twos down towards 95. But it's going to take longer, and that's what markets do. In any case, it's, to sum up the bonds, it's a period of flattening curves, higher for longer, pricing out any cuts for 2023 and certainly the first part of 2024, possibly pricing in more cuts in 2025, as the argument will go that tighter policy now ensures even looser policy then, because the odds that the economy is going to have a bad patch sometimes towards the middle of 2024 have to increase, because if the terminal rate goes up another 50 basis points and with higher for longer, it just increases the odds that something bad is going to happen later rather than sooner. The dollar should like the deal. Inflation differentials should go out a little bit. And therefore, I would have thought that any kind of a move up to here towards 105.25 is going to happen. It's going to be very interesting what happens there. This 105.30 area, I would have thought, is going to get touched. And, well, mid 105s, let's call it that, and that is precisely where the 200-day moving average is and turning down. That's going to be the safe part of the trade. After that, who knows? We'll get more details, but I would have thought in the first couple of days we are going to push towards this 105.5 level in the dollar. I don't think inflation differentials are going to remain at those levels. I still think they're going to come in eventually. And therefore, eventually I see a lower dollar. But for the time being, this 105.5 level that we've traded so many times and was a swing seems to be the destination. I think you probably know what I'm going to say about gold before I say it. We've changed the front month, and therefore this is prices are slightly higher than the spot. But on the spot, we have broken 1959 to the downside. And since I think that the yield curve flattens and bonds, especially the short end, go up in yield, and I think the dollar spikes the levels we've just mentioned, the odds are that we continue down in gold, or certainly the upside is extremely limited. To me, gold has 1881 written all over it. And look at that, we have the 200-day moving average down there, much like we do in DXY. It would be fitting if we still have a gap here in 1902. So I think, whether we get to precisely 1881, who knows, but that is going to be the direction of travel. I think the first move in gold is going to be one of very big disappointment, and that we head towards 1881. DBC should be encouraged by the debt ceiling deal. On a encouraged on a spread basis to gold. Okay, so this is the chart of DBC to gold. I think we could go and test something like 736 and still be within the uptrend from the moving averages. Something like that would really not surprise me. And, that's almost, a 6%, 7% move, something like that. Could be that DBC does not a lot and gold does most of the move, or it could be that DBC takes up, half of it. That would make sense. Gold down to 1881 and DBC more or less in this range still. There is no reason, if we go back to oil, since DBC is like, I don't know, well over 50% oil. I haven't looked at the recent percentages, but it's well over 50%. It was even 60% from memory. No real reason why oil should be sold on that news. There could be some other news which causes oil to be sold, but it's not going to be the debt ceiling deal, because there's going to be no fiscal drag, and therefore the economy should remain stronger for longer. I can't see that is negative for oil. Some other factor could be, but we are at the 200-week moving average, sloping upwards. So I think oil is going to hold in much better than gold, and therefore DBC gold as a spread, if we have a look at it, should come down as a result. It might only come down to 764, but with the pressure that we have on, we could easily see 736. So calculate what that is. I don't have my calculator right in front of me, but that means very little for DBC and more for gold down, I would have thought. Now, equities should like the deal. What happened last week? Basically, they went and retested the lows of the range. Let's try and actually enlarge this a little bit. and then just gapped up. These moving averages are all supporting, and you can't even test them. It's not because all sectors are doing well. In fact, most sectors are doing badly, but it's because tech is doing so well. To me, this is a breakout, and it will continue to break out slowly, slowly. And we will see the mid 4300s. If we look at a clean chart, and here we have my clean chart, I would have thought 42.55 is the minimum we will trade. And then I'm afraid that we'll actually break out and test these levels around 43.23. I can't see that we won't do that. I know that the market is very expensive. It's priced for perfection. But I think the tech will continue to trade higher, and therefore basically levitate and stop everybody out and make everyone go long. Let's face it, this deal is one of why own bonds and why not own equities. So that will be the direction of travel. People will continue to sell bonds to buy equities. Which sectors they buy at what time doesn't really matter, because basically what happens is that NQ goes up most, SPX goes up in the middle, and the Dow and the Russell go up least, if they go up at all, kind of thing. And it's just more of the same. As one sector stops going down, the indices stop going down, one sector goes up and drags everything straight back to where it was, which was the story of last week. We were slightly afraid of some debt deal, back down to the support, straight back up. This has to tell you that the market wants to go higher still. NQ being the only one that really matters. I mean, I find it hard to believe that people aren't going to push for this gap close, which is 14,800. I find it very, very difficult to believe that we don't see 15,000. It's really as simple as that. Whether this is a bubble or not, I mean, who cares? You trade it from the long side, and you keep on trading it to the long side until it no longer works. You just have very sensible stop loss policies and ensure that what you make on the upside, you don't all lose when it turns round and comes back. But that is a trade management issue, not a directional issue, and certainly not for the next couple of days. I just don't understand people who keep on trying to short it. Why would you do that until you get a reversal signal? More overbought can get more overbought, and certainly you go with a bubble, you don't go against it, because you have absolutely no idea when it's going to stop or how far it can go. Can you go above 15,000? For sure. It just does not pay to pick a top here. It's plain silly. The Nikkei is trading perfectly technically. 30,400. It traded down to on this correction, straight back up. It's another leg. Just don't short it. Is it overbought? Yes. You don't have to own it, but you have to trade it from the long side. If you have a look at this, if you take the distance here and put it on top, the target is 36K. And we all know how Japanese markets trade. They trade in one direction. And any kind of retracement is very, very quickly bought back, and the trend continues. Japanese markets are the most trending that you ever have, and the quickest trending. Therefore, if you don't want to own it, that's perfectly all right, but don't short it. It's death. This market will trade 36,000, whether it takes, 6 months or 8 months or 2 months. I have no idea. I just know that when the Japanese markets get in trend, do not short them, ever. And Europe is doing nothing wrong for the time being. Basically, all it did is fill the gap that we had down here. Support was 42.26. It just stopped short and straight back up. It was still down on the week, unlike many other markets, unlike the Nikkei and unlike the SPX. But you know, SPX is not like it went a million miles week on week. It just shows you that Europe is probably getting tired and will trend up less than the other markets, which is not surprising because it had the strongest recovery to start off with. But it's not bearish. And if the weakest market, and let's say that Europe is now going to be the weakest market, is actually going sideways to down, sideways to up, what does that tell you of the other markets like Nikkei and like NQ and like the SPX? It tells you that their trend is higher. And don't forget, none of my risk indicators since the beginning of the year have said that we are in a risk-off period. The only one that did it briefly was the 530s, and that reversed. So the odds that the stock market will have any kind of significant setback in the next foreseeable future are very low. And therefore you are looking for places to buy. You're not looking for places to sell. This is SPY TLT. It's basically breaking the highs. And you're looking for a move of at least something like this on top of where we are. So we are looking for 414 down to 385. Call that, and let's call it 5%. Okay, so you're looking for another 5% move. If I am correct and you are going to see very little in TLT, that means that the move is going to be almost exclusively in the SPX. So work that out. ITOT over government, so that's the totality of the market, okay? And that's a completely different picture because this is all government bonds and the whole of the stock market. So that includes the little stuff, right, that's not moving, like Russell. To me, this is also breaking out of this range, and the likelihood that we test the upside is, you know, the previous highs is not bad at all. So we're looking for a move from 4 to 416, and that just tells you that the totality of the stock market is not going to be sold here. Eventually, this is going to break up, and then you will be in a, you know, real bull market. But this tells me that the totality of the stock market is still going to be constrained. And what does that tell you? It tells you that if Nikkei is going up, if Europe is not going down, if NQ keeps on powering ahead to 15,000, it just tells you that the pressure is going to remain on the bonds, and relative to the bonds, the stocks are going to do better. Well, I've kept it clear and concise and short because I know it's the Memorial Day weekend and you'll have better things to do than listen to me drone on about the markets. I've changed all these levels, but you understand what I'm saying. I think twos have very little hope and are going to trade down in price. I think the stocks are going to be very well supported, and I see a continuation of the trading that we have seen, simply because the debt ceiling, if everything that we are reading so far, and this is Sunday, so the details are very sparse, is correct, then the fiscal drag is going to be minimal. Minimal fiscal drag basically means continuation of all the trades that we've been having for the past couple of weeks. and a yield curve which keeps on flattening. Gold, really, I think now 1881 is my favored level. Thank you very much indeed, and tweet you tomorrow.